We've got Taher Badshah joining in. He's our market master of the day. And of course, he is from Invesco Mutual Fund. Taher, thank you so much for being here with us. So, the market's had its hurrah moment, and it's been a fabulous comeback from those early April lows, right? The question really is now what next? Because now we're back to asking about the micros, about things like earnings, till the flows come back in a big way. So when we talk about those core fundamentals, which is earnings and valuations, how are we poised after this strong pullback in April?
I think before we saw this market once again start to kind of recover significantly over the last 6 odd weeks. I think what we had seen was roughly about a 10% correction in the valuations of large caps and probably close to about 12 odd percent on the mid cap indices, and perhaps more closer to about 18-20% as far as the small cap index was concerned. From there onwards, of course, we've seen a rally, and good part of it is probably covered. So I would assume that still compared to, let's say, December 31st levels, which were where the markets probably peaked, we still probably have some valuation decline. But meanwhile, like as you rightly said, I think the focus after many of the other clouds having cleared over the space of the past few days has shifted to earnings. And on the earnings front, I think what has come out so far seems to be quite nice to see. And probably that should impart some support both to the strength of the market as well as overall valuations as well. So I think what we've seen up until now, whether it be in the large cap space, mid caps as well, there's been a fairly strong delivery of earnings. We are still halfway through the earnings season, but by and large, in terms of representation, probably about 70 to 80% of the market cap in each of these three buckets is probably now already through, and we are seeing roughly about double-digit kind of growth at an aggregate level. But mid caps have done stunningly well with probably a 18 odd percent growth, if I'm not mistaken. That's what I probably saw at an aggregate level. Small caps have trailed, but partly also on account of commodities and metals. If you strip off that, it is still single digits, not too great, but nonetheless, I think it takes away a lot of risk as far as expectation on earnings is concerned, and particularly compared to the September and December 24 quarters.
Taher, hi, morning. Reema here. Is there a real risk that money moves out of India into China? When you speak to other investors who have that option, is there going to be the tactical switch?
It's quite likely. I think even before probably the last week that we saw climb down as far as US-China trade tensions were concerned, we felt that, at least I was of the opinion that probably this time around, when flows return to emerging markets, there will be a fair bit of China too will be a reasonably decent beneficiary, unlike, let's say, over the last 2-3 years when generally India has dominated the scene. And that's thanks to probably, deep seek at one level, and probably the realization over a period of time that the Chinese economy is trending somewhat differently compared to what it has traditionally been. Traditional sectors have started to kind of look a little more, stable, real estate, infrastructure, their own domestic consumption. And alongside which it is now probably being viewed from the lens of, an economy which is reasonably tech oriented, whether it be in the form of things like artificial intelligence, automation, robotics, medical automation, etc. So I think the complexion of that economy is changing, and probably global investors would be inclined to look at least some parts of the economy from that lens, which perhaps is a place where India probably does not provide them that opportunity or exposure. So I think it'll be India plus China in terms of flows as we go along, and especially if emerging market flows improve on an aggregate.
Okay, all right, Taher. Good to see you after a while, Taher.
Thank you very much.
How would you position yourself, though? Because the domestic interest is back now. And over the last few days, you've suddenly seen that the broader markets are actually doing well. And the point you made that earnings haven't been as bad as expected. So as of now, would you be tilting towards the mid and small caps that actually took a hard hit, or would you stick to the large cap names?
So, Nigel, actually, we didn't really back off from the mid cap and small cap space as much over the last some time. We've been through the thick and thin, and we also probably were not in the camp where we believed in terms of, taking those cash calls and stuff like that. So I think generally we don't do that under most market circumstances. So I think that has kind of probably, helped us to recover quite quickly, especially in this recent rally. So at our end, I don't really think there's been much of a change. At the margin, probably I would have thought that our mid cap and small cap exposures would have only gone up in the recent few weeks or a couple of months. We continue to ideate out there. We continue to probably find pockets of interest, either growth oriented or probably value oriented. So I think we are pretty much there when we probably have only gained at not having actually disrupted the balance of our portfolios despite the volatility in the market.
Taher, for mid-caps, obviously, it's usually always bottom up. But in terms of a theme or, some sort of a segment within the mid-cap or small-cap arena, is there anything where you see clear visibility, something that excites you right now?
Well, I think basically at one level we are probably a little more positive on NBFCs, for example, to some extent. That is where we probably find opportunities in the mid-cap space. Few pharma companies, that is something which also probably is interesting. Some of the industrials have actually also done well, both in the mid-cap, in the mid-sized market, as well as some of the larger cap names have also done well. More particularly, we all know defense has actually made a roaring comeback. So even there, we have a few mid-sized entities as well. So I think these are some of the areas which I believe have, where we have probably increased our exposures. I think mid-cap tech, especially in the more recent decline, has also offered some opportunities. Maybe not as much on mid-cap, perhaps mid-cap as well as some small caps too. I think have also helped us out there, and that is an area we have looked at least from a valuation standpoint or a value standpoint, especially after the correction which happened post April 2. So I think these are the few spots where we probably have added to our exposures and weightages.
Okay, what
Sorry,
about...
just one question. On Midcap Tech, is it the IT services companies or would it be some of these ER&D companies like a
It's
KPIT
largely
Tech?
been the IT services company.
And you would go back the high growth ones? Because there the valuations are relatively expensive.
They have been sticky. Valuations have been sticky, but delivery has been reasonably strong in some of those names. So we have continued to back some of those. Perhaps some of the, as we've gone down along the tier, some of the small cap entities have also probably taken our attention. And it's not as much because they've done well in the last quarter, but looks like at least that they've had specific factors which have affected them. Probably looks like the worst is behind them. Some trends which are emerging, which seem to suggest that the next few quarters should turn out to be better. And then, of course, valuations have been supportive. So I think that is where we have basically set our sights.
Got it. Final question before we let you go, Taher. I think real estate was a pack that you liked, earlier.
Real estate, right?
Real estate, yes.
Yeah,
You're maintaining a positive bias, and if you could tell us at least geography-wise, you're where you're more bullish.
So I think so I like real estate and especially after this correction, I think real estate is an area which I would still prefer. I think as we see decline in interest rates, that should be further supportive. By and large, from a more structural standpoint, we believe that this sector is still in its relatively early stages. I would say we have another 2-3 years to go at least for the cycle to hold itself. We've not necessarily gone by geographical preferences because quite a number of the companies that we own have their anchors in certain specific areas, locations, whether it is south or north or perhaps east. But largely, we've looked at them from a perspective that which are the ones which, if they try to become pan-India players, should be relatively easier for them to do so and should be able to extend their presence in other locations. So that has been the driver, that has been the driving theme as far as a stock selection in this space is concerned.
Okay, all right. Final question on consumption. You'll be leaning towards discretionary, I think so.
Yeah, we have a fair bit of discretionary, within which I think we would have probably, altered a few choices. Noting the fact that, we are probably likely to see some deceleration as far as urban-centric consumption or discretionary growth is concerned, and a and a pickup on the other side as far as rural is concerned, or perhaps value retail is concerned. So there would have been some shift in that regard. We would have added to a few value retail, segments, and probably also a few of them which are basically in things like QSR, etc. Once again, a little more tier 2, tier 3 driven. So that's where I think our incremental choices have been. But once again, it's a fairly decent mix. At the margin, we are probably move more towards some of the value retail stories.
Taher, it's interesting you mentioned QSR. I was looking at numbers of Westlife, came out with numbers, I think, yesterday. And even companies like Jubilant, finally, those numbers have started looking up after many, many quarters. So the entire QSR space, or this restaurant space, food space, so to speak, how are valuations here? Now the numbers, the earnings seem to be catching up. At least they're not as bad. Is there a further runway ahead? Because we all know the big talking point, of course, has been this additional 1 lakh rupee in the hands of people thanks to the income tax cut, and whether that is going to boost demand further. What's your sense?
So obviously, valuations are not of the type which are mouth-wateringly cheap. But basically, I think quite a number of these names have been at the bottom end of their business cycle itself over the last 2 years, primarily because a larger part of the incremental growth in many of these do come out of the non-urban centers, and the non-urban centers have probably been a little slow over the last some time. But things are probably likely to change. Perhaps if we get a good monsoon, interest rates are already coming down, inflation is coming down. That probably gives a little more space for discretionary spends to go up in the mass segment of the income pyramid, and that is probably what will drive incremental growth, if at all, for some of these QSR companies. So that is where we are basically laying our bets and trying to play that segment.
Great conversation as always. Thank you very much for joining in. Now, as